All right, welcome back, my friends, to the Mail-Right Real Estate Agent Podcast Show. This is episode 103, and we're coming out of the 4th of July weekend, so I hope everyone had a wonderful holiday weekend, as well as I want to thank all our men and women in service. Thank you very much for your service to our country, allowing us to do what we do. All right, I have a special guest. Well, I just said I, and I cut out my co-host, Jonathan. Jonathan and I have a special guest.
You'll be dying to do that as soon as you join the show.
They're my guests. They're all mine.
It's all mine.
Our guest today is William L. Exeter of Exeter 1031 Exchange Services. And in case you're wondering what the heck's a 1031 exchange, that's exactly why we have Bill on today. Bill, would you say hello to our audience and tell them a little bit about yourself?
Hello, good to see everybody today. I've been in the 1031 exchange business now for 34 years. So we've done a lot of exchanges over that time frame and seen a lot of interesting exchanges over that time frame.
I would imagine.
So really all we do is tax deferred strategies.
Okay. And Jonathan, would you please introduce yourself before we get underway?
Yes, folks, I'm the founder of Mail-Right, a marketing Facebook company that gets you quality leads and hopefully sales. Back to you, Thomas.
And I'm Thomas J. Nelson. I'm a residential realtor here in beautiful San Diego, California, where I'm never too busy for your referrals. And I help people not only buy and sell real estate, but invest in real estate. And that's where my buddy Bill comes in, because Bill and I have worked together in the past through mutual clients of ours performing 1031 exchanges. Bill, that brings me to the first question, the obvious question: what the heck is a 1031 exchange?
It's kind of a party kill, isn't it?
Yeah. We're diving in deep to some exciting content here. But it's exciting for us, right? Because it's a tax deferred event, and that's a big deal.
Absolutely. So it lets somebody who has rental property, investment property, or property used in a business sell that and reinvest in other replacement property. And by doing the 1031 exchange, they defer the payment of all their capital gain taxes, depreciation, recapture taxes, et cetera. So it's really designed to help them get out of one asset into another without paying any taxes and keeping the money in their pocket so they can build their wealth faster.
All right, I'm going to geek out here and ask you, what is really a 1031 exchange in the sense of where do they come up with the name? Why is it called a 1031 exchange?
A good question. So it's named after the tax code, so Section 1031 of the Internal Revenue Code, and it actually dates back to 1921. So we've got a long track record of doing tax-deferred exchanges.
Okay. Now, I want to take a step back before we dive into my questions about 1031s. You mentioned 34 years in the 1031 exchange business. So, I mean, what were you doing prior to owning this company of yours? What led you to start this company?
We actually were working for a bank, so I was controller of a bank up in Los Angeles, and the chairman decided to start a 1031 exchange company. Their outside counsel said, don't have the escrow company run it. We think that's a conflict of interest and an agency problem. So he put it in my lap, and I had no idea what it was. Unfortunately, a couple of months after that, UCLA had an extension program on 1031 exchanges, and that's how I got into the 1031 exchange business. This is actually the 5th exchange company that I've run and managed.
Oh, okay.
So back in 2005, we just decided we wanted to be able to do things for clients that the larger exchange companies we were running wouldn't allow us to do because they were either publicly traded or regulated or what have you. So that's why we decided to get into this business and start the Exeter Group.
Okay. And now, what were some of those things that you're able to do that the larger companies can't do?
When you get into more sophisticated transactions like reverse exchanges or improvement 1031 exchanges, there's debt often, and we have to sign off on the promissory notes, the deeds of trust, as the entity that holds legal title to the property. And a lot of times when the entity is publicly traded, they're not permitted to do that because it'll throw their financial ratios way out of whack and off track. So they just refused to do it, and we kind of caught a few clients off guard. So we decided to do what's right for the client. We needed to be non-publicly traded and non-affiliated with certain types of companies.
Gotcha. So, I mean, and this may sound like an obvious question, but I'm still going to ask it. Why do people elect to do a 1031 exchange in lieu of just selling the property and cashing out?
Good question. That's really the core of what we do. If you compare two investors side by side, and one goes through 40 years of selling, paying the tax, reinvesting, and then you compare that to the other investor who every time they sell, they do a 1031 exchange. At the end of 40 years, the investor who's done the 1031 exchange over and over and over and over will have a much, much higher net worth because they've deferred the money or deferred the taxes and kept the money in their pocket and working for them and building wealth for them instead of paying about a third of your profit to federal and state government.
So it's essentially one investor's experiencing one taxable event at the end of his run versus somebody that's been taxed repeatedly through the years.
Exactly. Yep. And a lot of people ask, what's the best way to take advantage of the 1031 exchange? And really, if you keep exchanging throughout your lifetime, never sell, never cash out, never pay the tax. When you pass on, you leave the property to your heirs, and they get a step up in cost basis, which means the capital gain tax disappears, the depreciation recapture tax disappears. So we have a morbid sense of humor. We call it swap till you drop.
Nice. I love it. Now, does that include, can you leave the property to a charitable organization or something like that?
Absolutely. Yep. So in a lot of cases at the very end, they may decide to set up a charitable remainder trust, something like that, or maybe they just leave the property through their will or through their living trust to some charity.
Okay, gotcha. And then time frames. This seems to throw a lot of confusion. What are the time frames? Because there are deadlines in 1031 exchanges.
Yes, there are deadlines, and that's probably the most difficult part of actually going through the 1031 exchange. They all get triggered upon the closing of your sale transaction or the closing of your replacement property, depending on which type of exchange you're doing.
Right.
Most people do a forward exchange. You sell first, you buy second. In that case, when your sale transaction closes, you have 45 calendar days to identify what you're going to acquire. That's the stressful part. That's 6 weekends. It moves very quickly.
Yep.
After the 45 days, you've got 135 days above and beyond that to complete your exchange, which means close on your reinvestment activities. It's a total of 180 days.
Okay. So in other words, then in the first time frame, that's the time to find a property and get it into escrow, and then you have the second time frame where you have more time to close the escrow in case there's delays or complications.
Exactly. That's absolutely correct.
Okay. Now, what happens when, let's just say I'm in my 45 days and suddenly something goes awry with that, and now I'm left with maybe 4 days to, is there any kind of extension under those circumstances?
Unfortunately, there's no extension. In fact, the IRS doesn't even have the authority to grant an extension.
Okay.
So it's exactly 45 days. And if you get to the end and you don't have anything identified, then your exchange fails and just becomes a taxable transaction.
Okay. So, I mean, worst case scenario, you're still closing on the deal. You're just, but and you alluded to this, so we might as well bring this up. There is such a thing as a reverse exchange, which I'll ask you to explain, but that could really leave you holding the bag. More so, I would imagine, than if you did a forward exchange, but correct me if I'm wrong.
Yeah, there's really kind of two different risks there. So with a forward exchange, you're selling first, you trigger your capital gain taxes and your depreciation recapture taxes. And if you can't find property and identify within 45 days or close on it after that, it's failed and you pay the tax. So the tax can be painful. With a reverse exchange, you're buying first. It's more complicated, more expensive, so your fees are greater.
Right.
But you're buying first. If you can't sell your current property in time, you'll end up owning both properties. So that's the risk with a reverse exchange.
Yep.
So the reverse eliminates the risk of a failed exchange that creates a tax consequence. The forward, of course, can create that risk, but the reverse then creates the possibility of owning two properties
Right.
Probably not what you intended.
Right. Yeah. And that's what I was alluding to as far as like, that's probably the bigger risk, unless you're financially capable of carrying two properties, then it would actually become the lower risk because you have more time to perform the exchange.
Absolutely. And in today's market where you're getting, multiple offers and bidding
Right.
wars and whatnot, and there's a, low inventory, the reverse can take a lot of the risk out of the exchange process, as long as you have the ability to sustain that transaction. We've actually seen a 450% increase over the last 2 years in reverse exchange activity. So it's a huge, dramatic increase.
I would concur with that, because I never even heard of a reverse exchange until about 2 years ago, and that's because in the last 2 years they've seemed to be a good 50% of what comes across my desk.
Yep, I think it's time for us to go for our break, actually, Thomas.
Okay. All right, we're going to take a short break, and then we'll come right back with some more questions with our guest, Bill Exeter from Exeter 1031 Exchange Services. All right, we're back, and we're going to continue with the questions. Before I dive back in, Jonathan, did you have anything you wanted to ask Bill?
Oh, this is all above my pay rate,
I guess, believe me, when I first got in,
I'm a simple coder, marketer. I'm not.
This was actually one of the things that made me feel like a hotshot when I was a new agent, because I had been an investor for 10 years with my family, long before I ever held a real estate license. So 1031 exchanges were about the only thing I knew about real estate going into it. Okay.
That's a huge head start, because most people have never heard of it. And if you mention a 1031, their eyes glaze over.
Yeah. Well, and that's the thing is, we as realtors, we make the mistake of using inside language on the outside world. And I'm constantly reminding myself of that. I have lost deals because people think as Jonathan just said, they think I'm talking above their head, and they don't want to work with somebody like that. So it's all about learning this so that we can speak it in plain English to them. And I think a tax deferred event is probably something that a lot of people can identify with.
I got one quick question. It's a very similar situation in the UK. It's this. What is the Internal Revenue's attitude towards this scheme? Because, there's some things in the UK that you're quite legally can do, but they will trigger a investigation from the UK tax authority. And that is their attitude. Does it kind of trigger more interest in you, the individual?
Good question. For the most part, it doesn't really trigger any increased risk of an audit or anything like that, unless you have a really large transaction. I think if you got a large transaction, you're just on the radar screen. But most transactions are under $5 million. The audit ratio is very, very low. There are certain states, like in our state, California. California has actually put it on their top 10 list, literally. And so they're more aggressive and actually, frankly, more obnoxious about it. So we're more concerned about California than we are the IRS.
Well, and let's discuss that for a minute, because one of the other things we haven't touched on yet is, let's talk about how a 1031 exchange works in the sense of the properties you're actually exchanging. So what is the rule? If I'm selling, let's just say I'm selling a $500,000 home, what can I exchange it into?
Good question. So first, the home you're selling, you have to make sure that it's rental, investment, or business use. It cannot be personal use. So if you get past that, we've satisfied the qualified use requirement.
Okay.
That can be exchanged for any other type of real estate that's also held for rental, investment, or business use. And that's a really broad definition, because it can be things like water rights, air rights, mineral rights, certain types of oil and gas interests would all qualify as like-kind property. So there's still a lot of people out there who think that if you sell a condo, you have to buy another condo, and that's completely wrong. Any kind of real estate is like-kind as long as it's rental, investment, or business use. Okay,
so you can exchange residential into commercial or into industrial?
Absolutely.
Okay, and then let's just say, okay, let's take another example. Let's just say we're well, I'll use an example that's real world. You're selling $1 million home in San Diego, and you're moving to Arizona to retire. where the price point's a lot different. So, I don't necessarily want a house big enough to qualify for $1 million property. Can I divide those proceeds from the sale into multiple properties?
Absolutely. So the 1031 is really a great way to diversify, which is exactly what you're talking about. So we'll have some clients who will say, I've got one asset of maybe $1 million, and I really want to sell that and buy 4 or 5 assets of 250,000 each. Maybe they've got all their properties in one city and they want to diversify by geography. There's a lot of different reasons why they might want to diversify. Usually it's some type of risk management goal.
Okay. So in other words, I could take a $1 million home, and when I say $1 million home, I'm saying my sales price was $1 million. Now, do you, and I should ask this, do you deduct the cost of the sale from the property before, and it's at the net gain, or is it the gross?
It's actually the net sale price is the technical item, but consumers get confused there because the closing statement has all sorts of stuff on it.
Right.
So it's only the selling expenses, your broker's commission, title and escrow, recording fees, documentary transfer tax fees, exchange fees, etc. Any lender expenses would not be deducted, and any operating expenses would not be deducted.
Oh, okay. All right. So it's really just your closing costs get backed out of it. Outside of that, everything else counts towards it, towards your credit, let's say. Let's just call it a credit that you're going to now apply to other property. And I can go out and as long as I meet or exceed that value, I can buy a house, a mobile home, 6 condos, and an oil well.
Absolutely.
Okay. All right. Clear. So the other thing I wanted to ask you is, are you, and I should say we didn't mention this, you're San Diego based, but you can do California statewide exchanges. Is that correct?
Correct. We actually cover all 50 states, so we no matter where it's located. We're also one of the few exchange companies that handle non-real estate, or what we call personal property. So in fact, you guys had mentioned, Jonathan, you were in marketing and whatnot. So we actually do exchanges of domain names, so internet website domain names.
Oh,
I never knew you could live with one of those.
Yeah.
Absolutely. They exchange one domain name for another domain name. We've done a lot of equipment and whatnot like that, livestock, baseball franchises, Subway, McDonald's franchises for other franchises. So there's a lot of different types of exchanges that you can do besides real estate. And
wow.
A lot of people have articles out there where it says you cannot exchange foreign property, and that's not true. You have to exchange U.S. property for U.S. property. But if you also, let's say, have rental property in the U.K., and you're going to sell that, and that's going to trigger a U.S. taxable event, you can exchange that for other rental property in another foreign country, maybe the U.K. or any other foreign country, and you can do a 1031 exchange of foreign property, but it has to be foreign for foreign.
Oh, interesting. Because what I'm noticing in San Diego, one of the big trends is a lot of people here are investing in Costa Rica. So that would be something they could use. So in that example, because they were California based and they bought a Costa Rican property and they go to sell that property, they're going to have a taxable event in the United States. Mm-hmm. So they can then exchange that property and move it to Tahiti if they wanted to.
Absolutely. That's
okay.
Exactly right. Yep.
All right. I didn't realize that. I had no idea. So you're not bound by your geographic location. You can do an exchange anywhere, essentially, in the world, depending on the circumstances.
Absolutely. There's only maybe 2 or 3 exchange companies that actually will touch foreign property transactions. So we're one of them. We're actually set up so that we can receive and hold in about 19 different foreign currencies. So the other exchange companies, when they receive the proceeds, they convert to U.S. dollars. That exposes the client to foreign currency risk. Right. With us, we hold in the foreign currency and then wire back out in the same foreign currencies, so it won't be a risk to the client.
Okay. Understood. Well, the other kind of exchange I wanted to ask you about is, can you explain what an improvement 1031 exchange is?
Sure. So I guess the best way to do that is with an example. So let's say that they sell $1 million asset and they go to buy replacement property. Maybe they buy dirt for $250,000. So we have to reinvest $1 million to defer all of our taxes. If we buy dirt for $250,000, we've reinvested $250,000. We're still short about $750,000. So during the 180-day window, they can use that extra $750,000 to make improvements to the property. So whether that be, putting parking down, curbs, whatever, or even a full, construction of a building and what have you, whatever they can pay for and complete as improvements during that 180 days would be considered part of the exchange.
Okay, but they have to actually break ground and complete construction all in that time frame.
Yes, and so the whole project doesn't have to be completed, just the $1 million value that we have to invest. So maybe it's a $5 million construction project. All we care about during the 180 days is that we get $1 million paid for and $1 million worth of construction completed. The rest can be done after the fact.
So, I mean, I don't want to sound like I'm the natural negotiator and I'm always poking holes in things. So how can you, let's just say that time frame's not realistic, but can I stack my deck and buy all the building materials that I'm anticipating needing and maybe front load some prepayments to my contractors? Would that accomplish it?
Unfortunately, no, but it's a good question because that's what most of the clients try to do. But what they'll do is,
I thought it was unique.
It's my 179-day help. What do I do? Can we take to the lumber yard and have them drop the lumber off?
Right.
And on the 179-day, if they drop the lumber right there, it's still personal property because it's been constructed or made part of the real estate. Once they add, say, the drywall or put up any kind of framework, then it becomes part of the real estate. Then it would count. Okay.
So I almost feel like I'm asking the wrong question. So let me rephrase. What do you see people do to make that time frame work for them? What's a strategy that's working well for people?
Good question. The first thing is you want to sit down probably with your architect and maybe your construction crew or what have you and ask the question, excuse me, is there anything we can change in the construction process to move the expensive stuff up front? For example, we had one last year where there was this incredibly beautiful water fountain that was scheduled to be at the very end of the construction project. And it was a very expensive piece that was going to go out front of the office building. And by moving that and they put that in first, they were able to get that done fairly quickly and spend, it was about $1 million just to get that whole front thing done. And that actually solved the problem. So sometimes just moving or scheduling it differently, front loading things might be the solution.
Okay.
I've got a question. Obviously, I'm getting the impression, rough, and it's probably a very difficult question to answer, William, but roughly how much does this cost to set up from you and your company?
Good question. If it's a regular exchange, so you're doing a forward exchange, selling first, buying second, with one property sold, one property purchased, it's just a flat fee at $799. If you get into reverse exchanges or improvement exchanges, then it's a lot more complicated. Yeah. We actually have to take title, or what the IRS calls park legal title, to the property. So reverse exchanges are going to be somewhere in the neighborhood of $6,500. Improvement exchanges, probably $7,500, maybe a little more. That's for anything up to $5 million. Over $5 million, we just have to evaluate the risks to us. And
no, I'm very surprised. Actually, it sounds very reasonable prices. Actually,
yeah, no, it is for the money you're saving. It's value added to the whole process. And and we've successfully worked with Bill's company in the past with clients. So, and I know that they've, I always ask my clients when I refer them to somebody else, would you use them again? And they said, absolutely, yes. So Bill's kind of my go-to guy. And I've asked this question to Bill before because I've personally wanted to do this, but yeah. I'm going to ask it again here. I wanted to 1031 exchange one of my rental properties from the Bay Area down to San Diego, but then I wanted to turn my existing home into the rental and move into the exchanged property. And what did you tell me, Bill?
It depends. That's my favorite answer.
Yes.
So it can be done, but it can't be done right away.
Right.
You have to satisfy the qualified use test, which is you intend to acquire that and hold it as rental, investment, or business use. People get hung up on the length of time to hold title to the property. Lots of people will say, well, you don't qualify because you didn't hold it for a year or 18 months or 24 months. And it's surprising when we tell them the code, the regulations, none of that has any required holding period. What it does say is you have to have the intent. Well, how do you define intent? And
Right.
that's the tough part. So, certainly if you exchange into property, rent it for 24 months, and that's going to straddle 3 separate income tax returns, I think that's really good proof that you had the intent to hold for rental. And your intent can change then. So at that point, your intent changes, you move into the property and convert it to your home. But if your original intent was to live there and they can prove that, then you're in trouble.
Okay. And what we're getting at is that's kind of an IRS event then, because they're looking for tax returns that mirror the intent that we just discussed.
Absolutely.
Okay.
Yeah, I think we need to wrap up the podcast part of the show and maybe have a little bit of bonus content.
Okay, so Bill, what we're going to do is we're going to sign off on the audio, which goes on our iTunes and Stitcher, but we're going to continue with a video conversation and bonus material. So So I'm going to ask you to give people your contact information in case they want to ask you questions or utilize your services, but then stay on with us and we're going to continue the conversation.
Okay. They can certainly call us, email us, or go to our website. So my phone number is area code 619-239-3091. Again, so that's 619-239-3091. The website is exeterco.com. So that's EXETERCO.com. Or you can email me directly at william.exeter@exeterco.com.
Excellent. And Jonathan, if people wanted to reach out to you for mail, right, how would they do that?
Oh, it's really easy, folks. You can get hold of me personally on Twitter at Jonathan Denwood. I think I'm the only one with that Twitter handle. Or you can get us on the Facebook page. You can message me, or you could email me directly. And that's jonathan@mail-right.com.
And I'm Thomas J. Nelson. You can find me on my website, thomasjnelsonrealtor.com. Social media, I'm on Facebook, Twitter, and I'm on LinkedIn, as well as Active Rain blog site. And I'm never too busy for your referrals in San Diego, California. We're going to sign off the podcast portion of our show and continue with some bonus content on our video for YouTube. Thanks for joining us, folks. We'll see you next week. All good? All right. I'm never sure how long to give you to close.
3 or 4 seconds.
Okay. All right. So before again I take over, do you want to? Do you have any questions that I've been?
Yeah. Well, why? It's good news. I don't know if you think it's good news or bad news. I've never heard of this. And why do you think it's not more well known? Because I'm no expert on finance, but I have some interest in it, and I watch a lot of video and podcasts about finance. But I never heard of this. You got any insights why it's not so well known?
I think it's an ongoing educational problem. I mean, when I got into the business 34 years ago, even CPAs and attorneys would tell the client that, oh, this is illegal, you can't do that. So it was constantly about, no, you can, it's actually in the tax code, etc. And now it gets more and more familiar to those who are really active real estate investors, but most investors have 1, maybe 2 investment properties, so they're just not aware of it. And as we do seminars and podcasts and things like that, the word gets out, and it's probably more well known on the West Coast, less on the East Coast. We joke about it being a California phenomena. California is 1031 exchange capital of the world.
So. To clarify, if the individual dies and in their will they request it to family members, what is the situation then? Are you passing a very large taxable event to relatives, people that you've left the property to?
That's a good question. There's kind of probably multiple prongs there in terms of the answer. Some family members like to gift property to their kids or grandkids or whomever. And that's a gift that's done prior to death. And that's usually not a good idea. If you're gifting property before death, you're gifting them the capital gain too. So they're going to have a wonderful gift later on when they sell that property. But if they leave it to the person usually through their living trust, then the person who inherits it usually gets a step up in cost basis, so the gain goes away. So I would recommend that they talk to their accountant and make sure they're holding title properly, so they're going to be able to pass on that step up in cost basis.
Yeah, I mean, Jonathan, to both your questions, I think a huge part of the problem is you get people that fancy themselves to be investors, and as Bill said, they maybe buy one or two property. They don't do it through an education of history of investing, nor an education that they should be getting from their realtor that helps them, assuming they used a realtor, because sometimes the realtors have no clue, but they want the gig. So they're not going to tell you, I don't know anything about investment property. They're just thinking, okay, I know how to sell houses. I'm going to sell a house, but there's more to it with an investment property.
Yeah, I was going to ask you that actually, Thomas. When do you choose to actually bring this up to maybe a client that's working with you?
Day one, I ask them what the intent of the house is. Why are you buying the house? And and then even if they plan, and here's a conversation, because I live in San Diego and the majority of my clients are military, I know that the majority of those clients are going to be moving on in 3 years because of their duty. So I always ask them, what are your plans for the home after you get deployed or relocated? And a lot of them have no clue. They haven't thought that far ahead. So I put that thought in their head, and I always recommend to people, I don't like to talk people out of a sale. That's how I survive, but I believe in the relationship more than the transaction. So my best advice is if you can keep it and rent it, I've got great property management companies that can help them with that. Hang on to it, build a portfolio. I watched my grandparents build wealth through real estate, and because they bought and hold. This fix and flip thing doesn't work for me. I'm a buy and hold kind of guy. I get it that people make money on fix and flips, but and that's their option. I don't tell my clients what they should do, but I make them aware of what's available. And then we talk about the 1031 exchange opportunity down the road, should they not want to stay in that investment property.
Oh, right. That's great.
So yeah, it's all about educating. The biggest two of the biggest problems in real estate, as I see it, is poor communication, and we're not educating our clients. So their expectations are out of whack with the reality of the market. That's why I always tell people I'm a transporter. I take people from fantasy land and bring them to reality, and we go through the hard questions and the hard discussions that some agents and salespeople in general don't want to have, because they're afraid they're going to talk their client right out of a sale or maybe postpone a sale. But to me, I'd rather have my clients set up for success, because that's what gets you referred business, is when they've had a good experience, when they've had something that's worth bragging on and they want to share that experience with their friends.
And sometimes if you talk a client out of the deal, we do that all the time, where we just say, the 1031 is not appropriate for you. But you know what, is they remember that because you did what was right for them.
Right.
They'll come back to you in the future because you talked them out of it when it wasn't appropriate.
Absolutely.
Well, that's a good question. What are one or two key factors that make, based on your experience, William, that makes this particular setup inappropriate?
One of the first issues is talking to the accountant to find out exactly what the gain really is, because sometimes they've owned it for a short period of time, 18 months, 24 months, what have you. And in other states, you don't have the type of appreciation you see in California. Right. So their gain might be, $20,000, $30,000, $40,000. And then you have to ask the question, if you pay taxes and your taxes are $6,000, $8,000, $10,000, is it worth going through all the hassles of the 1031 exchange and the fee and all of that for a small amount of tax? It might be easier just to pay the tax and then have all the time in the world to find the right property.
That's a great point.
The other times is that they do the exchange and they're in the middle of the exchange and they're coming up to the 45th day and they buy junk because they don't want to pay the tax. Sometimes you just have to let the exchange fail and pay the tax, and that's the better way to go, Otherwise, you end up with a horrible long-term problem because you forced yourself into something.
Yeah. Yeah. Sometimes, I mean, we've got to, it's kind of like parenting, Jonathan. Sometimes you let your kids discover how things work, and other times you keep them from burning their hand or cutting their finger off. So it's the same with clients. I mean, you give them some latitude to make their own decisions, but you kind of bracket them in with your experience and your knowledge. And there are times, I just had this happen this morning. I referred a client to a friend of mine in Las Vegas, and she called me back and said, hey, I had to postpone them because what she can afford doesn't put her in a decent area. And this is a young single woman that we don't want to see, in a bad neighborhood. So we're going to postpone. And that's the relational approach, which is, one of the reasons why I work with Bill, because I see him take that same approach with his clients.
All right. Yeah, they're yeah.
More of an answer than you were expecting.
I've got nothing intelligible to add to that.
Bill, one thing we didn't touch on was the simultaneous and concurrent 1031 exchange close. Could you just explain that real quick?
Sure, and those are difficult to do in today's world, but actually it's probably the best way to do it if you can. So literally you're selling relinquished property, you're doing a 1031 exchange, you're buying replacement property, and you're able to coordinate so they both close at the exact same time, same day. And in some cases, you don't need a professional qualified intermediary when that happens, as long as they know how to structure the deal. In most cases, they don't know how to properly structure it. They'll still hire us for a concurrent closing just to make sure it's documented properly. But the beauty of that is you close on the sale, you close on the purchase, you're done, and you don't have to worry about the risks of what if I can't find replacement property. The reality is it's very difficult to line everything up and have it close in the same day. Today's market just makes it very difficult to do that.
Yeah, especially in California. And I would imagine if you're crossing state lines with some of the properties, that could be a nightmare because everyone's time frames are different.
Absolutely. And speaking of crossing state lines, California has something called the California Clawback. They've always had this. They've always taken the position that if you sell an exchange out of California, it is still tax deferred. But in the future, when you sell and cash out, if you cash out, California wants their fair share.
Oh, that's a good point to bring up. So you're going to get, so if I buy in Arizona and then I end up selling, I'm going to get taxed both in Arizona and California.
Absolutely. And a lot of people would exchange into states that don't have a state tax thinking I avoided the California tax. But California now has a methodology to track it. So starting in 2013 now, they track that.
Wow.
If you sell and you don't pay your fair share, they will come after you.
Even if I leave California, if I relocate,
if you sell all of your assets in California, you move out of California, you still have to file an information return every year, giving them an update.
Is that well, I'm a bit shocked because I'm really shocked by that news. Is that going to be challenged in the federal courts at all?
I think it probably will, and I think it probably should be. And a lot of the tax attorneys we talk to think that it's unconstitutional. But until somebody wants to put their money where their mouth is and fight them, it is what it is. So, we still have clients who exchange into states that do not have state taxes in hopes that at some point in the future they won't have
I live in one of them. I live in Nevada, and we have a lot of Californians that have moved this. I live in northern Nevada.
Oh, yeah.
And the economy is dominated by Californians moving to northern Nevada to avoid tax obligations,
Yeah. But unfortunately, I mean, to your point, Jonathan, I think it takes the power of something like National Association of Realtors to get behind, challenging that, because or at least the California Association of Realtors, because that's fighting the government, And I mean, I just know from back in the short sale days when a bank, and I won't name any, but they would do something blatantly illegal. And you would call them on it, and they'd say, great, just have your lawyer call our lawyers, and we'll take it from there. which was basically their way of saying,
Yeah, because I got to be. I don't want to go in politics, but I'm quite open. I'm quite progressive, but even my eyes widened when you were saying that, William.
yeah.
To me, that sounds. Whoever thought that particular one, I don't see that flying for too long myself. But there we go.
It's certainly very frustrating.
Well, and this is why I love having guests like Bill on, because if you were to base your investing portfolio and strategy on what you learn on HGTV, whew, I mean, it's eyes wide open when you really look at all the, I mean, you have to talk to a lawyer, your CPA, a 1031 exchange person, an experienced investor, realtor. I mean, to get the whole picture, so you know what you're getting into on the buy side and down the road on the exit strategy.
You bring up a good point too. The real important point there was a team. And
right.
Most investors never have a team.
Right.
If they get their, a really good tax attorney, a CPA, and a real estate attorney, and the realtor, and everything lined up, they're ready for whatever gets thrown at them. But in most cases, they don't have anybody lined up, and then something happens, and they don't know what to do.
Yeah, they get into a mess. I've seen that a lot, or you see inexperienced teams. I'll tell you, and I have a lot of good clients that are doctors, but I have come across conglomerates of doctors that pool their money together with no clue what they're doing, and they get together with the wrong realtor that just wants to take advantage of that, and then you just see this mess. And I see it on the when I'm representing buyers, and we go into this property, and you're not, as you're buying it, and you realize you're buying it from this LLC, that there's no money coming back to them. You can do the math, and you realize they're in the hole selling this thing.
Absolutely.
And you see that a lot because people don't go in with the exit in mind. They just they get all fired up to buy the property, and I think some of it's bragging rights. Yeah, I'm an investor. Well, I don't think you're an investor until you make a few mistakes and maybe have a failure or two, and you really learn the whole story of being an investor.
That's how you learn.
Just to wrap up, actually, Thomas. As an experienced long-term property investor, and your family have, also long-term, and you hold basically, which I totally agree with. Have you got any kind of general advice of what kind of properties you look for? Is there any generality that you can give based on your experience of it, or have they all been so very different that there isn't any pattern?
There's an old expression, go for what you know. I could not advise anyone until I got to know them on what they should buy, because it's what their comfort level is. A lot of it's proximity. I mean, I'm comfortable owning rental property 500 miles away from me. Somebody else might not be comfortable with it more than 5 blocks away from them. Do you want a condo versus a house? What's it going to be used for? Is this a long-term yearly rental that you're going to lease, or is this an Airbnb or a vacation rental? There's a million things to consider. So I appreciate the question, but it would be irresponsible of me to give out a generic answer to that, because it depends on who the investor is and where they're investing and what their resources are and their level of experience and their level of risk.
Yeah, that was a great answer. I've got to go now, guys. Okay. I made you a co-host, so you can continue if you wish. Or shall we wrap it up?
Okay. No, we'll go ahead and wrap it up. I know Bill's a busy guy, and I got to get going too. Yeah. But Bill, once again, will you give our viewers your contact information so they can reach out to you for more good info?
Sure. So they can get a hold of us by phone at 619-239-3091. Again, that's 619-239-3091. Through the website at exeterco.com. So that's EXETERCO.com. Or they can email me directly at william.exeter@exeterco.com.
Awesome. And we're going to put your contact information up on the show notes too.